Hello, how's everyone doing? Today is our market recap. Thanks so much for joining us. This is Greg Lewis. I'm coming at you from my basement, aka the MetaStock Temporary Studio. Today's guest for the weekly market recap is Jeff Tompkins. If you were here to see Anne-Marie Baiynd, we apologize. She had to cancel because she didn't realize she had a previous event going. We are going to be starting here in about 3 minutes. I do see that Jeff Tompkins and Jeff Gibby are both raring to go, so there should be no problem. I do want to take a moment to, we see people coming on. Hey, as you're coming on chat today on YouTube, go ahead and make sure you say hello and let us know where you're coming from. We always enjoy that, and we'll say hello back. And remember today, if you have any questions for Jeff or Jeff, they're both monitoring YouTube chat, and they will answer them. Today's presentation is only being brought to you on YouTube, and if you want to watch the recording later, it's right here. You just have to rewind. So we've got about 2 minutes and 45 seconds. In that time, what was I going to tell you? Oh, we have the APAC Summit coming up on August 15th, and we did just announce the speakers. So let me show that to you real quick. Right here. Okay, so here's the speakers. We've got Guy Cohen. He's from England. We have Mark Belnick, I believe Australia. Our own Hunter Smith. This thing's hard to navigate. Gary Burton from Australia. Tim Stratton from England and Zurich, I believe. And also Daryl Guppy in Australia. Those are all very what am I trying to say? Very expert traders in the APAC region. So it'll be a really interesting presentation. I should point out that the times you're going to see on there are for Singapore. So as far as Eastern time, it starts 8 p.m. on Friday evening and goes through to the early morning. But if you're in Singapore, it starts at 8 a.m. And when you get the registration back, or when you just get the email back, it'll show you at your local time when you can watch it. So if you want to register for that, go to metastock.com/APAC Summit, APAC-Summit. metastock.com/APAC/Summit. Or just go to metastock.com and there's a big banner right on the top. All right, we're going to be starting in about 1 minute, so I'm going to go ahead and put myself on mute and make sure things are going well. Hello, Pradeep from India. Hello, India. And hello, Jeff Gibby. We'll be starting in just a minute. Thank you so much for your patience. All right. Hey, everybody. I'm Jeff Gibby over at MetaStock. Hope you're doing well. Thanks for coming today. Hope you had a good week. Hope everybody's staying healthy and staying safe. Let's go ahead and read this fancy little
Legal disclaimer. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any I lost my place. MetaStock shall have no liability for any investment decision based on the use of their software, any trading strategies, or any information provided in connection with the company. I've only said that like 3,000 times. One of these times I'll get it right. In any case, we have a very good guest today. Jeff Tompkins has been a partner of MetaStock for a number of years. One of the things I'll say about Jeff Tompkins in terms of a way to introduce him, he's a very, very good educator. We do a lot of online webinars with him. One of the things that really stands out to me is I remember back in January. If you remember January, it seems like forever ago, but I remember in January we were doing a webinar and he was talking about how maybe we shouldn't be quite so bullish as we were in the marketplace. And I thought really literally at the time, you're insane. You're out of your mind, Jeff. And turns out he kind of had a bit of an idea what was going on. So I'm very interested to see what he has to say today about the market and all that kind of stuff. But let's go ahead and bring him on here. How you doing, Jeff? We can see your screen.
Oh, good. I'm doing well. How are you?
Good, good. So some interesting
voice.
Yeah, it's always good to have you in here. I guess jumping right into it, we see some interesting numbers this week with 32.9% drop in GDP, $1.8 trillion drop in GDP. Unemployment rate looks a little bit better. It's only 11.1%. Market's kind of a little bit channely, I would say, for the last week or so. What's your take on things?
Yeah, and interestingly, the market keeps wanting to push higher in the midst of all these negative fundamentals that we're seeing in the headlines. So it's I would say my take on it is, and it's a reason that I don't really focus too much on fundamentals in my trading. I really, the market price action is really based on human emotions, fear and greed. And so for that reason, I'm more of a technical trader, and I'm going to share some of my technical outlook on the market. And generally don't get too deep into the fundamentals, but certainly it is interesting that in the face of all of these, negative fundamentals that we're seeing come across the newswire, that we continue to push higher. Although we've seen a little bit of stalling over the last this past week, although we did end up closing, we kind of had a choppy day today in the market and ended up closing higher, which actually put us in the green for the week, which could be a bit bullish for next week as well. We'll kind of talk a little bit about that on our session, but that's really my outlook. And I really just, as you know, from being on past market recap sessions, really try to focus more on the psychology of price action, the fear and greed that drives prices up or down. Because, right, who would have thought that after such a steep sell-off in an unprecedented pandemic, that we would have seen such a quick bottom and also such a quick recovery of prices in the market. So it is pretty interesting, but we'll kind of map that out and provide some rationale behind it in our session today.
Sounds great.
Yeah. So if you want, I can just go ahead and dig in.
Yeah, go for it.
All right. So as I mentioned, I really focus on price action and technicals because that's really what, when we're making decisions as traders and investors, we should be focusing on because, surprisingly, you can have very good fundamentals and you can see downward trends in the market, or conversely, you can have very poor fundamentals, as Jeff mentioned a few minutes ago, and see upward trending prices. So really the reason for that, again, is really psychology. And to me, that's what drives prices in the market, is basic human emotion like fear and greed. And that's actually something that we're going to translate over to price action in the market using some of the tricks that and analysis that I use in my own personal trading, as well as in my hedge fund, Altos Capital. And so what I'm going to share with you is how to read these types of supply and demand points in the market that really are a result of fear and greed or human emotion, and how to really analyze those, interpret them, and act on them to make trading and investing decisions in a more consistent, accurate fashion. So you'll notice I've just got a standard price chart of the S&P 500, the SPX, pulled up on the MetaStock platform, and I've plotted an indicator that I use frequently to assess those human emotions that translate into price action in the markets. So it's the Bollinger Bands. And for those of you who are familiar, it's a volatility study that plots a centerline moving average and volatility bands placed at two standard deviations from the moving average for the upper and lower band. And the reason these, they can be used in a lot of different ways, but the reason that they're so valuable is that they tell us basically in real time, without any lagging component, what the volatility in the market is doing. And I'll show you a very unique way to use these that can really explain what happened in this Corona crash in February and March, and why we're back up to these levels that we are now, and how you can use it going forward to help navigate these types of volatile market conditions. So basically, you'll notice that when prices are in a nice steady uptrend or moving sideways even, the volatility bands are going to be relatively close together. And you can see that they can get very close together even in a nice steady uptrend. And that's because volatility is low. And when things go haywire, as they did in February and March with the Corona crash, the bands will diverge, and rather than move parallel to each other or even converge towards each other as they do in some cases, instead we'll see them pointing away from each other, and they'll widen and expand. And what will happen is price, rather than bouncing off the band, as we see it commonly do within a trend or a sideways moving market, we'll see price bounce off the lower band, move to the upper band, bounce off the lower band, move to the upper band, so on and so forth. Instead, we'll see price hug one of the bands. And in the case of a sell-off, of course, it's going to hug the lower band. And one of the warnings of this is when the bands are very close together, because that's when volatility is low. So most traders and investors, and this is where the psychological and emotional component of trading comes into play. Most investors will get overly optimistic, overly exuberant. They'll start buying. And this is why often you get inexperienced traders and investors buying at tops and then getting hammered in a sell-off like this. But when you see the bands close together, that's actually when you should be fearful. And when you see a divergence of the bands and price hugging the lower band, in this case of a sell-off, that's when you want to actually be greedy. So you want to kind of have that that counter approach, or that basically contrarian outlook or view of the market, and that will actually help you buy low and sell high instead of buying high and selling low, which is what unfortunately most traders and investors do. So the way that we can use these bands to make that decision is that when we see a volatility expansion, as we do here on the chart in the February and March crash, as price is hugging the lower band, we want to start looking for buying opportunities to get back into the market. And I'll tell you why. Because 100% of the time, if we go back to every black swan event, market crash, bear market, you name it, back to the beginning of the stock market, we'll see that anytime there was one of these volatility expansions, in other words, the bands diverged and we saw a sell-off in the market, price 100% of the time has come back up to the point where the band broke. And I'll draw that on the chart for you here. So I often get asked, how are we trading back up above 3,200 on the S&P? Well, you'll notice that the volatility expansion occurred right around the 3,200 level as the market sold off in response to the growing coronavirus pandemic, COVID-19. And what happened when people ask, well, how are we back up? Because this is what I call a rubber band effect or a slingshot setup. And what happens is the smart money, the big institutions, hedge funds, etc., come in and take advantage of the fear from retail investors that are getting crushed in this sell-off and are unwinding positions, and they come in and buy from those people at a much lower price. So regardless of what the fundamentals are telling us and any sort of even economic outlook, those things get pushed by the wayside. And what's happening here is all the smart money, the big institutions, are coming in and scooping up shares at drastically reduced prices, and that's really what's driven the price back up to this level. And so I call this the slingshot setup. And basically what happens is when this price hugs the lower Bollinger Band, there's a volatility expansion. It comes back up and retests that level. And you'll see where I've drawn this line here. So it actually retested it back on June 8th last month. And we obviously, you can see that served as a resistance area for quite some time. We finally broke through it here in July over the last week or two, and we're holding above that level right now. And I'm going to make a comment on that here in a minute in terms of the significance of that. But what I want you to realize is that this is what happens in these types of extreme sell-offs. And you can see this happen all over the place. Here's another one. This was a volatility expansion. Price sold off quite significantly and came back up and retested the level where the band broke. Here's another one here. And it happens with astounding accuracy. Here was the major one in December of 2018. There was the volatility expansion, price hugging the lower Bollinger Band, and then coming right back up to that level. And so that's simply a volatility expansion and a volatility contraction. And it happens with near certainty. Now, of course, the trick is where do you buy? How do you know where the bottom is? And we don't know for certain exactly where the bottom is, but there are a lot of different techniques that we don't have the time really to get into today on our session to get in for the move back to the upside. There's things like dollar cost averaging. We can use different momentum reversal indicators, etc. To pinpoint this the momentum shift and the reversal back to the upside. In fact, we have a tool available, an add-on available on the MetaStock platform called TradeTrend that I developed, that is available if you guys want to check it out. That does give really nice, accurate reversal signals in these types of conditions. And in fact, TradeTrend identified a buy setup right here near the bottom. I believe it was on this candle right here on March 24th. And got us in quite early in this rebound. But that's really where we sit now. And we'll notice that we're starting to see some volatility contraction again. So the bands are now pointing, the outer bands are now pointing more towards each other. And the center band of the Bollinger Bands, the moving average, is sloping up, and price is staying above that band, as well as above the 3,200 level. And I'm going to map out a couple levels here also in just a second, but that's significant. And as long as we stay above this level here, which actually is about kind of right around 3,225 to be more precise, then that's bullish. And if we close below 3,200, which really now serves as support, then that would be bearish, and we'd be looking for our initial target level at the lower band. And if we break that band and have another volatility expansion like we did in February, because we haven't had one since then, right? Every time prices come near the lower band, we've traded back up off of it. So if we break this lower band again and we have a volatility expansion, that's where you really want to be cautious, take profits on any open positions, protect your capital, etc. Or implement a bearish strategy to make money on the sell-off. So what I do in terms of mapping out the horizontal levels is I really focus on 3 different benchmarks on the S&P. I use the S&P index to map these levels out. But this could all be repeated on other indices like the NDX, the NASDAQ, or the Russell 2000. But I like to use the S&P as a benchmark. And what I look for is the century marks, the half century marks, and the quarter century marks. So a century mark, of course, would be 3,200, 3,300, 3,400, so on and so forth. And those are the levels we're going to watch for on resistance. And actually, 3,400 is right around the level we topped out at before the crash. So that's really a strong level of resistance. And then to hone it in, we can then look at half century marks, which would just be like the 3,250, the 3,350. And that's really, all you need to really look at. But if you want to really dial it in a little bit more, you can look at the quarter century, like the 3,225, et cetera. But these levels are very significant. They're watched by big institutions, et cetera, that, really drive a lot of the movement in the market. So they're important to pay attention to. So really I use the Bollinger Bands, the outer bands of the Bollinger Bands, as more of a dynamic support and resistance zone. And then I also mark my static horizontal support and resistance at these century marks. And if you just, you could do a quick exercise at home and map these horizontal levels out at the century marks and go back on your chart. And it's really interesting to see, of course, I didn't map them down far enough, but if you go all the way down to some of these lower century mark levels, it's really interesting to see where you'll see price action around these levels. And there's also millennial marks. So the 3,000 would be a millennial mark level. But you can see how price will often reject these levels. And then once it breaks through, that's where you can see some really big trends set in place. So like once we broke above 3,000, after we kind of played around with that level for 4 months or so, we really pushed higher before we hit all-time highs, and then the crash ensued. So now this chart looks like a Picasso. It's getting a little messy, but hopefully you can see these levels. And I really wanted to share this slingshot setup with you guys because when we do have another crash, which was always inevitable, we don't know when it will occur, but hopefully I've given you some tools to help identify when it's a higher risk of occurrence. And then when it does occur, you can be confident in knowing that the market will rebound at that level at some point. And we can be contrarian and actually go in and buy at lower levels versus being fearful and selling and taking losses. And so there's a lot of ways to do that. Again, beyond the scope of our session today, but certainly buying protection with options, et cetera, can be really good to do in these types of volatility expansions, making money on your hedge on the way down, and then holding your position for the rebound. But there's lots of ways to play these, but the more important thing is just know that they occur and how to interpret and analyze those. Any comments, Jeff, or anything?
Yeah, I was in terms of one of the things that kind of stood out to me with that was you had talked a little bit about as we hug the upper band, we should start to be fearful. That looks like it was a pretty good idea in the June area. We kind of hugged that band for a while. We kind of then bounced to the lower band. And now I'd say we're at a point that we're kind of hugging the top of the band a little bit up until maybe the first of this week. Which is, I think the way I kind of heard you, though, is you're optimistic as long as we stay above 3,200, 3,250.
Yeah. And, obviously, when interpreting the market, it's always a moving target.
Right.
Nimble and flexible, so things can change on any given day. But which is why I generally spend 15 to 20 minutes every afternoon after the market closes to just do a quick analysis, like I'm sharing with everybody today, and I just kind of run through that same process that I just shared with you and on my own. But yeah, so where you would have been after the sell-off and then the rebound, where you would have been looking to take profits on positions or start to kind of unwind and maybe go to more cash would be on a return to this 3,200 level where the volatility expansion initially occurred. So that would have been back in early June. Once we're up to that level, and coincidentally, see what happens here, we get a lot of choppiness, et cetera, because we've already recovered to where the sell-off really started to accelerate. So if you think of it from a contrarian standpoint, or think of it instead of being, a retail investor or trader sitting at home on your laptop, think of it from an institutional standpoint. Thinking of it from a money manager standpoint, where you've got somebody over at Charles Schwab or Morgan Stanley or one of the big brokerage houses who's putting a lot of money into the market for their clients, and they started buying down here, right? So they've now recouped any losses and potentially made profits, depending on how they implemented that. But once they get back up to where the market started to the sell-off started to accelerate, they're going to start unwinding positions and taking profits. And that's why you see this type of price action after we get back to this level. Now, the question mark often is when this slingshot effect, that's just a name that I coined it the slingshot because it kind of acts like one. Once that occurs, sometimes you'll get stalling around this level and then a subsequent sell-off, or sometimes you'll get a big move back to the upside once we break through this level. And so the way that I kind of determine the probability of that is how long do we stay above the level where the sell-off accelerated. So that would be the 32.25 level. So we've now closed above that level for a few days in a row here. We kind of toyed around with it a few days prior to that, but we also had quite a few closes above that level previously. So this is all bullish. And as long as we continue to close above 32.25, there's the probability goes up that the prices are going to push higher. So as long as we stay above 32.25, the probability is we're going to go up to 3,400 on the S&P, which were right near previous all-time highs. Now, again, if we close below these levels, that would be bearish, and we'd want to shift. We need to be adaptable to shift our strategy to more of a bearish strategy or protective strategy. Remember, you want to be greedy when others are fearful and fearful when others are greedy. It's kind of one of Warren Buffett's old quotes, but it's very true. So yeah, right now I'm bullish on just the price action and the way that trends are setting on the S&P. Certainly, we're not speaking at all about fundamentals. There's a lot of damage that has been done to the economy, and we'll see what happens. And then, of course, we're in an election year, and that kind of throws another wrench in things. The administration is likely going to do everything they can to keep the market on an uptrend through the end of the year. So that's something to consider as well. And then, of course, the real big unknown is the viable COVID-19 vaccine and when that might be available, to the general population. And that could certainly have a positive impact on the markets also. So there's really a couple things on the fundamental side that are driving things up beyond this initial sell-off and rebound. So we'll want to keep, our ears to the ground on that one to see kind of what's going on. But
would you say that in the positions that you've got right now, Jeff, would you say that you're mostly bullish?
Yeah, so I have a long buy, like in my hedge fund, Altos Capital. I've got a long bias right now in the market. We just closed out another positive month this month, which is great, and I was bullish in virtually all of my positions that I hold in the fund, and so they did well this month. But I am being a little more cautious right now just because of the level that we reside at, where the volatility expansion occurred. So yeah, I'm just there's different ways to approach caution in the markets, right? So we can still be bullish, but One thing I do is I just trade smaller position sizes. So, whereas down here on a sell-off, I may have been more aggressive and traded larger positions to take advantage of this rebound. Again, I'm using a contrarian approach, and I'm being fearful when other people are probably being greedy. It's that whole FOMO thing where people fear missing out of these trends, but unfortunately, they use too much of a lagging analysis, and they say, okay, well, the market's been on an uptrend, so I'm going to jump in now. But unfortunately, they've missed a lot of that price appreciation. So I'm aware of that, and I'm being cautious in my position sizing, and really not actually taking any new positions right now till I have more clear direction on whether these major levels in the S&P are going to hold or break.
I think that's a good advice. Can we look at a couple stocks?
Absolutely.
Pradeep would like to look at Apple or Accenture, so maybe both of them for it.
Oh, okay. Let me close this out. Switch this over to a candlestick chart. I like candlestick charts a little better. So yeah, Apple obviously.
Wow, I have not looked at Apple today.
I haven't. This must be an earnings reaction. But yeah, Apple's obviously done very well. Far surpassed the high that it reached before the crash, the market crash, which is very bullish. And of course, companies like Apple that aren't going to be quite as impacted by these types of things. In fact, they can benefit from, the tech stocks have done well. They benefited largely from this sell-off. The one thing, of course, to be a little careful about is no company is 100% immune to these things. And so, of course, you have to be a little bit cautious because there's a trickle-down effect when consumers, lose their jobs, et cetera. They don't have as much disposable income. And, that's going to ultimately impact every business to some degree. And we may have just not seen that yet on the consumer side. But with that said, I think Apple's a good company. They've got a really strong balance sheet. They're going to survive this. They're not going to go under by any means. But I wouldn't be buying in probably right now after these things. And of course, the round of earnings we're seeing right now is still not going to fully encompass the impact of the closing of the economy and stuff. It's probably not going to be till later Q3, early Q4 till we really start to see that hit the markets. So the next round of quarterly earnings, we may want to be a little more cautious, but yeah, certainly this is it. And you'll see that same slingshot, although I don't have the Bollinger, I can throw the Bollinger Bands on here. Occurs with individual stocks as well. So you can see here that this is the volatility expansion, the sell-off. So this would have been a great area to start buying Apple. And of course, buyers who got in down here in the low 200s have seen a really nice return, over 100% return since March, as the stock has actually more than doubled since that time period.
What kind of what do you think when you see a big gap like that on the far right of a chart? Because for me, like when I start to see something like that, if I'm looking at Apple today for the first time, I'm kind of thinking, well, I think there's going to be a little bit of a settling, and I want to buy it a little bit, at least closer to the middle band, to the lower band. Is that a good way to look at this, or what do you think?
Yeah, I think so. If I were going to try to trade a volatility expansion setup like this, because remember you're in the uptrend, the bands are relatively close together. Now we're seeing a volatility expansion, except it's to the upside, not to the downside. That can still be an opportunity. Generally, if I were going to try to trade this, I would get in like with a buy stop above the high of this candle. It's just, I never like to get in at a top. I'm more contrarian, so I want to get in on a sell-off, not on a major move to the upside. So I'd probably look for a pullback. And the middle band, can be a good kind of buying zone, as you can see here. in the context of an uptrend. So as long as this middle band's pointing up as it is right now, and it was here, as you can see in this uptrend, this middle band, you can see we would have had a lot of really nice buying opportunities, just getting in the middle zone here, of course, until the crash hit. Yeah, I just prefer to buy low and sell high, and not buy high and sell low. So there's just a higher risk of a pullback on Apple right now. But maybe down near the 385 level, or even the 365 level, could potentially be better entry points, in my opinion, than way up here at 425. But certainly things look strong for Apple right now, and I just don't want to kind of fall victim to that FOMO mentality where, this
better get it while it's 400. Right.
Right. And then you get caught in a wedge, and you get a bunch of sellers coming in, and then you're kind of, for the long, it all depends on your outlook. I think for the long term, Apple's always a good stock to hold. I like to get in on the sell-offs versus after a major trend like this is already set in for 4 or 5 months.
Can we look at Kodak real quick?
Sure.
KODK.K. Actually, you can just switch the symbol without closing out the chart.
I like to do things the hard way.
Well, that's okay too. KODK.K. KODK.K. This one was an interesting one today, or this week, I thought. So, in case you don't know the story, a bunch of Robinhood traders pushed this up on a government contract. Thing. I don't know if you saw that in the news or not, but it's really had a little bit of a upward movement from like 2 to 50.
Yeah, I did see this. I saw this on Bloomberg. This is one of those ones you wish you would have gotten in, right?
Yeah, sure.
July 27th. But no way to predict that. This is an unpredictable event. But these are, when you see, a wide range bar like this, it's just not smart to get in. There's too much volatility. It will probably remain that way. Obviously, anybody that had the FOMO mentality and tried to chase this has now been probably hurt, unless you got in on the initial breakout on the 28th.
A. Hansen wants to look at Sohu. SOHU. Sohu? SOHU.
Oh, okay. Is that a .o or a .k?
I would bet .o. That's what my guess is going to be. Yep.
Good guess. All right. I'm really not all that familiar with this name, but it obviously has done well. Throw the bands on here to kind of see. This is obviously a major volatility expansion. But this is what I was kind of talking about with Apple. This may have been, without knowing this stock very well, I'm thinking this may have been a quarterly earnings reaction here, but I don't know that for sure. But this is kind of like, if it were, same picture with Apple, like if I were going to try to get into a move like this, we had a lot of gapping going on here, which I don't like to get in on big gaps. But, if I could have gotten in on a buy stop order above this breakout and volatility expansion, that would have worked out pretty well. But there's just too big of a gap here. You get in at 16, 15, now up near 23. But this is definitely one you wouldn't want to try to get in at this point, just because it's already, it's already almost tripled. It's more than doubled, but in price, certainly more than tripled from the lows. But from the volatility expansion, it's just pretty much doubled. Those are not the good times to get in, but this is also kind of research this one to see what occurred here. But you can see the same thing taking place over and over. You got the volatility contraction, bands close together. So a lot of people will try to trade these expansions. I can see 3 or 4 very obvious ones on this chart. Here's one right here. Here's one right here, and here's one right here. The problem with trading these is we don't know which way the expansion, the prices are going to expand. We do know that when the bands get close together, there's a near 100% chance of a volatility expansion. So trying to take a directional trade off that information is fairly difficult because we don't know which way it's going to go, unless you can kind of wait for it. And then there's different techniques you can use to jump on the trend on the expansion. But you see here is one, close bands, and this was a positive expansion, close bands, negative expansion, so on and so forth. This was a really major positive expansion. But there are a lot of great ways, to trade these, and when we teach these methods and to our student base, you can always learn more on our online training courses, etc. At altostrading.com, altostrading.com. We teach a lot of these, and we also offer our TradeTrend Signal Software. This is my little plug, by the way, that we developed in partnership with MetaStock. You can actually get more information at altostrading.com too. We have different subscription options on MetaStock. In fact, MetaStock also has a page set up for us directly through their website. I'm sure Jeff could share that with you guys in the chat if you're at all interested to try it out. But in any case, we do have an add-on for MetaStock that can help give signals. And I don't have it pulled up on the chart because this is really not meant to be a sales session by any means. It's more meant to be educational. So I'm not going to put TradeTrend on the chart, but it would be interesting to see where some of these nice buy signals would have come in before this major breakout on SOHUs. So, but yeah, this is a great one to look at. I like looking at these big ones. These are always like, darn it, why didn't I get in down here, right?
Yeah, if I could only scan the future.
Yeah.
Jude 3 has a question from YouTube. She wants to say, someone told me about an older indicator called Crossbow. Have you ever heard of it? I haven't heard of it, Jude.
Crossbow, yeah, we developed Crossbow. Actually is an indicator that we have available that we developed with Rob Hoffman's Wealth Charts. So that's available on their platform, but I don't want to talk about that because we're on a MetaStock platform.
Okay. Let's see. Patrick 10 wants to know if you have any opinions on IXIC or the NASDAQ.
Yeah, the NASDAQ, has obviously outperformed the other indices because tech earnings have been good and they've weathered this sell-off much better than some of the other sectors and industries. So again, getting kind of toppy here. But the one comment I would like to make on these types of events, pandemics, if you want to, really get in, trade the market on a broader index, the tech stocks often fare the best in pandemics like we're in now, because if you think about it, a lot of the names that are included in this index are going to benefit from technology that helps address the problem, and so that's why we have the same slingshot effect occur on the NDX, but not only did it return to the volatility expansion level here around 8,900, it's far surpassed that and reached new all-time highs. And so these can be, the NASDAQ can be a great index to trade, although of course more volatile than your S&P or Dow stocks, can often fare quite well in situations like this. Now, if we're in a sustained bear market, then I try to avoid indices like the NASDAQ or tech-heavy indices where they tend to get hit pretty hard in a sustained bear market. But you just want to that's where I do really take fundamentals into consideration is, what is the cause of these market catalysts? What is the catalyst behind these volatile market environments? And then, which industries and sectors are going to weather the storm better? And the NASDAQ would be one in a situation where technology is going to actually help improve the situation versus, be a victim of it. But right now, what I see forming here on the NASDAQ is a triple top. So you can see we've had, and the same exercise applies, mapping out the major levels on the NASDAQ is the exercise we did on the S&P. And you can see there's a major round level here at 11,000, and obviously price is having trouble breaking through that. So this would be our level of resistance that I'd be watching, which coincidentally coincides with the dynamic resistance on the upper Bollinger Band. So we break through that. We could see a continuation of the uptrend, but being contrarian, I don't want to buy in at a top. I want to buy in at a bottom, or as close to the bottom as I can get by doing things like dollar cost averaging in to a position. So this wouldn't be a point where I'd be trying to enter the NASDAQ. I would be waiting for a pullback to a support level before I would try to do that. And you can map out these big century and millennial marks and see where some of those levels are. But it's no coincidence that you see major price action that can serve as either resistance or support occur right around these big round numbers. That's just kind of my quick and dirty analysis of the NASDAQ.
All right, two more.
Okay.
But before you shut down the chart, I just want you to type MMM.
Okay. You're going to try to get me to do things the easier way?
Yeah, and then have it change it to starts with. And then you can just hit enter.
Okay. Oh yeah, I like it.
It did change it to a monthly chart though. The last time you looked at this, it must have been a monthly chart. So I see the big M over there. So you can change that back to a daily. The next time we change the chart, I'm going to make one more change for you to make it even easier. So go ahead and add your Bollinger Bands back in and change it to candlesticks.
Yeah, I'm going to go over to the candlesticks. How come it's offset?
It just is zoomed in a little bit further, probably because you went from the monthly. You can zoom out a little bit.
Okay. All right. Is this one you wanted to look at, Jeff, or one of the attendees?
This one is from Chuck Mume. Chuck. Yeah.
All right. Did Chuck have anything specific he wanted me to look at on this one?
I think he just wants to get a good opinion from you.
Yeah. So yeah, 3M is, obviously kind of in some sideways rangy price action. Here is the slingshot right here. So there is our volatility contraction, then volatility expansion. And as you can see, rather than, this would be an example of the price action of Baiynd, the upper and lower band. So we're getting a bounce here. Here's the expansion. The sell-off obviously coincided with the Corona crash. And then we get the return to, actually, we haven't gotten the return yet. Okay, this is interesting. We got close. I mean, we got a return basically to around the gap down, but I'd really be looking for a return to where the band breaks, which would be up at near the 175 level. We haven't gotten there yet. So this might be an interesting one to trade in the anticipation of getting back up to 175. But right now, what I see taking place is really just sideways ranging price action. The middle band is non-directional; it's horizontal. But we also are looking at potential volatility expansion here. Here, we had it back here, and then we had the contraction. The bands have been horizontal and relatively close together, but now it looks like we're in the midst of a volatility expansion to the downside. So I'd be watching this one. If we see a move lower below the low of this candle, that's going to be probably, a confirmed volatility expansion. So that's where I would be looking to get into this stock if I were trading it. And full disclosure, I'm not trading 3M. In fact, I don't hold any positions in any of the stocks that we've discussed today. But yeah, then you want to kind of start looking for your support areas, right? And what that is simply where his price significantly bounced off of in the past. And we can see this 130 to 135 zone. We had a big move off there. We've had some relatively small moves off the level I marked here around 150. But again, this could be a break of that level, which would be volatility expansion. And then I may look to start kind of dollar cost averaging into a position down around the 130 to 135 zone. If that were to break, we'd be looking at getting back down to the lows from March, which is probably unlikely. But we could always, average into a position down into the 115 level. And then I would expect that this slingshot would move back to this area here. Oh well, didn't do what I wanted it to do, but you can see it right there. Right around the 175 level.
Okay, let's do one more. I want you to type in TTW0, but don't hit enter.
Okay. TTW
O.
dot O.
No, just O first, and I think it is going to be a .o.
Okay.
TT. Yep. Now under options, you see where it says options?
I do.
Click on that, and then say use chart as template. Okay, and now hit enter or select instrument.
There we go.
Yeah, that was easier, right?
Oh yeah, I like it. Well, that's one of the reasons I love to do these sessions. You always make my life easier.
Cool.
Tend to do things the hard way.
This one looks like it's hugging the upper bands.
Yep.
To me.
Yeah. So the volatility expansion was right here. You see, price hit the lower band down here, hit the upper band. We're now in an uptrend. The middle band's pointing up. This would have been a good entry zone right here around 140. This is not a good entry spot because this is the FOMO trade. This is where people are getting in because there's already an uptrend and they're afraid of missing any further price appreciation. But unfortunately, at some point, this thing is going to fall back down. And so we want to be buyers on at lower prices on something like this. But I can see a nice support level around 150. So that might be, a place I could see institutions coming in and swooping up some shares around that level. But right now, the volatility expansion started here, right? So this is where instead of price, well, technically it really started here because we did have a reversion to the mean right here, and then truly it started here. So we don't want to get in on this long after volatility expansion to the upside. But yeah, that's kind of what it looks like. But certainly this stock is doing very well also. It actually weathered the Corona crash fairly well too. Because if you look at the sell-off here, it actually didn't get hit all that badly. And it rebounded pretty fast. Here was the slingshot right here. There's the volatility expansion. It started early February and it was back up and hit that same level in April. So in the April 1st. So in a matter of 2 months, it was already back up to that 122 level. And this is where if you did get on down here, you may unwind positions or take profits on a portion of your position, lock in some profits, move your stop to break even, and then with the anticipation that if price sustains a breakout above this slingshot level, we can often see significantly higher prices from there, as we have with Take Two. So that's what I'm watching right now in the S&P. If you guys recall that, we got back to the level. Here we had a little bit of rejection of the level there, but then quite a number of days, and I generally look for like 3 to 5 closes, daily closes above the that level, and then we can start looking at entering long positions. If we get a sustained breakout, in other words, 3 to 5 daily closes above the level. And sometimes you'll see some retracement and things like we did here, but obviously it would have been a very nice entry point, certainly into May, where we hit around, around 150, and now we're pushed much higher in this uptrend. So another fun one to look at. One's done very well.
Perfect. That looks like the end of them. So,
all right.
Any final thoughts?
No, just it's always a pleasure to be here. I hope you guys learned a little bit in terms of just doing. When I appear on these sessions, I really emphasize that top-down analysis approach. So really look at your indices, your SPX, your NDX. If you're going to be trading individual equities or options, or on individual securities, or ETFs even, this is a really great approach. It's one that I use in my hedge fund, in my own personal trading account, to give me a higher probability of staying on the right side of the market. So I'll always start out with this top-down approach, look at the indices, in particular the S&P, and then use that to help drive my trading decisions on individual stocks. So hopefully you guys learned a little bit from that today, but I just want to thank you again for having me, and look forward to coming back soon.
Awesome. It's great to have you. altostrading.com for your website, right?
Yep, altostrading.com. We have all of our online courses, trade alert services, our TradeTrend Signal add-on for MetaStock can all be found there. And if you have any questions, you can email us at support@altostrading.com.
All right. Thank you, Jeff. Appreciate it. Hope you guys enjoyed that. I always love doing these market recaps. Stay healthy, stay safe. Have a great weekend. We'll see you at the next one.